Hello, my name is Brian Heimel. I'm the founder of ForSellByInvestorTools.com. We have two very special guests joining us today. We have David Kotok, who is the Chief Investment Officer for Cumberland Advisors. Mr. Kotok co-founded Cumberland in 1973. His articles in financial market commentary have appeared in the New York Times, the Wall Street Journal, Barron's, and other publications. He's also a frequent contributor to CNBC programs. With us, we also have William Dunkelberg, PhD, professor in economics at Temple University, Fox School of Business and Management. Since 1971, he has served as the chief economist for the National Federation of Independent Businesses, NFIB, which represents about 600,000 member firms. Mr. Kotok, Mr. Dunkelberg, thank you very much for joining us today. We have seen historic lows on interest rates, and my question is twofold. Number one is, do you think they're going to stay this low, and if so, for how long?
Well, maybe I should take the
You
first
can go
shot at
first.
that. I can go first this time. The Federal Reserve has essentially used the term extended period repeatedly to say they're going to keep the short-term interest rate low for some length of time. Extended period has been interpreted to mean 3 to 4 meetings, roughly half a year, and it seems to be rolling forward all the time. The Federal Reserve policy essentially is geared to two things. The central bank has two mandates. Keep the economy fully employed. We certainly don't have that. We have a huge overhang of unemployed and a very long, protracted workout situation in the job side. And the other thing is to keep inflation low. As of the last reports, we don't have any inflation to speak of. The numbers are very low. Inflation is benign. So the likelihood is that the Federal Reserve will keep the policy interest rate low, probably all of this year, and possibly well into 2011. And then when they do start to take it up, and they do start to remove the continuing programs that have been in place, that the Fed has put in place in response to the crisis, they will do so very gingerly and gradually. I believe the view of the Fed, and I think it's my view too, is the financial system is fragile. It has been wounded. It is recovering and healing slowly. It has not fully healed. We are not back to business as usual. It's better than it was at the worst of the crisis, but it isn't over. So I would expect the Federal Reserve to be very slow about taking up interest rates based on what we see today.
So if I can reinterpret what David said, he said that the Fed really is in the posture is to make the supply of credit as available as needed in order to keep the price of credit low. Let me talk about the demand side, however. The private sector is a big user of credit, and of course the supply of funds that savers put into the banks and financial institutions is the money that we're tapping. Now, normally we build 1 million, 5 million, 6 houses and apartments in a year. We're only doing 600,000. That means that difference between those typically financed in the private sector, that demand is gone. We normally buy 1.6 million, 1.7 million new cars and light trucks every year. We're down around 10 million. Huge amount of credit demand that the banks usually satisfy, gone, not there. If you look at small business surveys that I do, plans to make capital expenditures, new equipment, expand the business, 35-year lows. Actual reports of spending, 35-year lows. So private credit demands for us in the private sector are very low, which has made it easy for the Fed to kind of keep rates low. But the issue going forward on where rates might be depends on how quick the private sector comes back. And if our credit demands start to grow because we are finally expanding our businesses, consumers are now spending, we're going to buy more houses, then we're going to have a collision between the $1.5 trillion deficit that the government's going to try to finance from the savings pool and the private sector demands, and that will push up longer term interest rates. How fast that's going to happen, we don't know, but we know it will happen, and of course government will win that battle because we're more sensitive to interest rates in the private sector than the government is, and we'll have to see how that all plays out, but it does mean higher rates down the road.
Thank you for joining us today. Please visit fsbtools.com for weekly updates on all things real estate.